Hello and welcome to Looking at the Markets with David Model. I'm going to try to explain the basics of options calendar spreads. This is a more intermediate options video, so you can go down below this video to the description and there's a link I'll put there for my playlist for options videos. So if you don't know much about theta, decay, and things like that, or what calls and puts are and how they work, then you might want to go to that options videos playlist and watch some of the more beginner videos and then come back to this one. And if you want more coaching on trading, investing, options, stocks, all that good stuff, putting together a trading plan, you can email me. I do provide coaching. You can email me at davidmoadel@gmail.com. All right, so this is Schwab, and this is a calendar spread. We'll use a calendar call spread, but the basic idea is the same for a calendar put spread. All right, so let's say the underlying equity, the underlying asset is Apple. Okay, you can do this with, this will apply to any stock ETF that's optionable. All right, but we're just going to use Apple. It is February 10, and Apple is around, let's say, $170 per share. All right, and let's say you wanted to buy a call option. Let's say, I don't know, it's February now, so this is June, so let's say 4 months out, right? Okay, and we'll make it at the money just to keep it simple, but you can put on a calendar spread that's out of the money or even in the money. That's okay. And we'll make it calls, but you can also do it both puts. The principle is the same. All right, and notice how expensive it is. All right, $11, around $11 per share. Let's say $1,100 per contract. Pretty expensive to buy a call. You can reduce your cost basis by at the same time selling a call. All right, notice how much lower my cost basis is. Let's say $32 per contract instead of, or per spread instead of $1,100, right? That's a lot cheaper, so you're risking a lot less. And with a calendar spread, it's a debit spread, so you're going to pay this out. And the most you can lose is whatever you paid for the spread, which is typical of debit spreads. And so instead of the most you can lose being $1,100 if you just bought a call here, the most you can lose now is $332 or so. All right, plus commissions and fees and all that stuff. But hey, you're risking a lot less at least, and doesn't cost as much. It's cheaper, lower cost basis. Cool. All right. And so what is the calendar spread? Well, the calendar spread means both the call, or it could be puts also, but let's say calls for now, both the call that you're buying and the call that you're selling at the same time, they both have the same underlying equity, both the same stock or ETF or whatever, Apple and Apple in this case. Same strike price, in this case both are, approximately at the money, 170 and 170, same strike price. Different expiration dates. That's why they call it a calendar spread. Two different dates on the calendar here. And generally speaking, the one that you're buying is further out in time, has more time on it, a later, further out expiration date than the one that you're selling. All right. So in this example, right now it's February 10. So this June, I'd be buying a June call at the money, approximately. So this is, let's say, 4 months out. And then I'd be selling, to reduce my cost basis, to make it cheaper, I'd be selling the April call, same strike price. So the one I'm buying is around 4 months out. The one I'm selling is around 2 months out. All right, so why would you do this? Well, first, to reduce your cost basis from $1,100 to $300 something, right? Also, you're hoping to capture the difference in time decay. Theta decay, because if Apple just goes sideways, right, just the price stays the same, it stays at 170, let's say, day after day, week after week, month after month. It's not likely to happen like that, but let's say, stocks go sideways sometimes. So let's say Apple just goes sideways, no price difference day after day, and let's say the volatility level stays the same day after day. So all other things being equal, price stays the same. Well, this, the one that I bought is going to go down in value from $1,100 to, $1,000 to $900 to $800 and so on, day after day, if the stock just stays the same in price. But also the one that I sold will go down in value at the same time, right? It'll go from $775 to $700 to $600 to $500. They'll both be going down. Which one will go down faster? Probably this one, the one that I sold. Because near-term options tend to have more severe theta decay, more severe time decay than longer-term options, right? So let's take a look. Just as a reminder, this is an intermediate video, so you should be a little bit familiar with this. If not, you might want to check out some of my other videos, the beginner ones, to learn more about theta decay and what that is. But yeah, an option that has 4 months left on it, if Apple just goes, or whatever, the underlying equity just goes sideways for a month, your call or put, whatever it is, will go down in value a little bit. Meanwhile, over that same month, the one that only has 60 days on it will go down more severely in value. And so if you bought this one and it loses a little bit of money in your option, and you sold this one and it loses a lot more money, then your spread, your calendar spread, should go up in value. No guarantees. Options are kind of funny that way. Things don't always work out as planned. But oftentimes, if the stock just goes sideways, then your calendar spread will typically or often go up in value. All right, that's what you're hoping for. You're hoping that the underlying asset just goes sideways. Ideally, Apple would just go sideways until the one that I sold, the short call, as they call it, expires, and then you'll just have the long call. You'll just own this call. This one would, let's say Apple just goes to 170, it stays there until the short call expires, the one that you sold expires. All right, and then you would just own this one. All right, and yes, this would go down in value if Apple just goes sideways for 2 months. Of course, this would not be worth $1,100 anymore. It would go down $900, $800, $700, whatever. But think about it, an Apple call with still 2 months left on it, right? Because in April, this June one would still have 2 months remaining on it. And so if this one expires, Apple's still at 170, this one expires, and now you still own this one, would an Apple call with 2 months left on it at the money be worth more than $332? Yeah, probably. No guarantees. Could be worth less than $332. Probably be worth more than that, though. So yeah, this would probably still have some value, still be worth probably more than $332, which I would pay for the spread here. And so I'd probably be able to sell this for a profit. Again, you're making quite an assumption here, though. You're assuming Apple just goes sideways for, stays at the money for 2 months. That's not necessarily going to happen. If you believe Apple's a good company, then Apple could easily just go up, or it could tank, could go down before the short call expires. All right, but you're hoping, ideally, that it goes sideways. The underlying goes sideways until the short option expires, and then you could sell, hopefully, the long option for a profit, for more than what you paid for the spread. That's the idea. Okay, so you're basically capturing the difference between this and this. All right, so that's kind of how it works, and you could do it with puts as well. If these were both puts, then again, you would still be hoping Apple just stays at the money, just goes sideways, and then you would sell your short put, and then you'd still have your long put, and you would hopefully be able to sell that for more than you paid, for a profit, for more than you paid for the spread. Hopefully, doesn't always work out that way. Options are funny, but that's the idea. That's how people typically make money from calendar spreads. All right. Now, some people don't sell their long call or put or whatever it is. They hold on to it and hope that if it's a call, they hope that as soon as this expires, or right after this expires, the short call, they're hoping that right after that Apple just shoots up in price. Apple skyrockets, and then you can make an unlimited amount of money, right? Because then this call option could just go up and up and up in value. And so in that case, you would hope that Apple would just go sideways for 2 months, and then right after this expires, it just shoots up. That's what you're hoping. now you're kind of asking for a lot there. That's, you know, now you're trying to time two different things. It's not easy to time one thing, not to mention two different things. You're trying to time the amount of time that Apple would go sideways, and then you're trying to time when it would shoot up in value. All right. So yes, you can make an unlimited amount. You can make a lot of money here, but you would need two things to happen, and you'd have to time them pretty well. That's not easy. If you don't have a crystal ball that works, then it's hard to time two different things like that. It's possible, but I don't want you to have the fantasy that that's likely to happen on a consistent basis. All right. Most people, I think, would rather just try to make money timing one thing. In this case, just the assumption that Apple would hopefully go sideways until this expires, and then you can make money just selling the long call for more than you paid for the spread. That would be the idea. If these were both puts, then yeah, conceivably you could, you know, if Apple just stayed at the money, went sideways for 2 months, then you could sell the short or sold put, hold on to the long put, and if you don't sell it, if you choose not to sell it for a profit, then you could hold on to it and hope that Apple just tanks right after this one, the short put, expires. But again, you're trying to time two different things. You're trying to time the sideways move and then trying to time when the tanking of the stock happens. Not easy to do. Most people don't have a crystal ball, I think, right? So it's hard to time two different things. So is it easy to make money from a calendar spread? It's tough. You really need the stock to go sideways until the short option expires, the one that you sold expires. You're kind of asking a lot there, but it could happen. There are people who make money from this, or claim to at least. So let me show you what the risk profile looks like. This is from optionsplaybook.com. And this is, let's say, the price of the stock at the expiration of the one that you sold. All right, or the front month expiration, you can call it. Stock price at front month expiration. You need it to stay the same, right, to make your max profit. If it goes down a lot, if the stock goes down a lot before the front month expiration, you could lose money, right? If it goes up a lot, also, you can lose money, which is really interesting. All right, here's another one. This is from theoptionsguide.com. Again, stock price at the expiration of the one that you sold, the front month near-term expiration. All right. So if the stock stays the same, you can do well, right? You can hopefully sell it for a profit. No guarantee. Options are funny that way. It doesn't always work out perfectly, but all right. But if the stock before the near-term expiration, if the stock, underlying stock or ETF or whatever goes down a lot, you're probably going to lose money. If it goes up a lot, you're probably going to lose money. Isn't that interesting? A lot of people don't expect that. So you could put on this trade, and then if Apple goes up a lot, if it goes up very sharply before, you know, the expiration date of the call that you sold, you're probably going to lose money because both of these prices will go up, right? As they both go further and further out of the money to the upside. It's interesting. If you put this on and then Apple immediately tanks, you kind of expect to lose money in that case, you know, because it's calls. So yeah, if the stock goes down sharply, you kind of expect to lose money with calls. And both of these would go down sharply, and this would, you know, the value of your spread would probably go down. Yeah, a lot. But even if it goes up sharply right after you put on the, you know, or before the expiration of the short call, even if Apple went up to 180, 190, 200, and so on very quickly, you would still probably lose money on your spread, which is counterintuitive. You know, it's unexpected, illogical seemingly. But what would happen is these would both go way out of the money. All right, they would both go up in value very sharply, and these two numbers, the two prices would get very similar. They would become very similar to each other. So the gap between these two would close. All right, and so, you know, this would go down because this is the difference between the two, you know, the two options, the one that you bought and the one you sold. And so the gap would start to close. The difference between these two would close as the stock goes further and further out of the money to the upside. And this would probably go down. It would go down from $332 per contract to, you know, 300 to 200, maybe 100, maybe even go to zero or very close to it. All right, as you can see, all right. Either way, stock goes up too much too soon, you can lose money that way. All right. So not easy to make money on this. You really need for Apple or whatever it is to go sideways. All right. So anyway, that's how you make money typically with a calendar spread. It is an interesting idea. I do like the idea of reducing your cost basis, reducing your risk, or at least maybe not reducing your risk, but in a sense, in a way you are, because you're reducing your cost basis, your initial outlay of capital there, so to speak. All right. And I do like the idea of capturing the difference between this time decay and this time decay. But that only happens, you can only capture that difference if everything remains the same. All other things remain equal. That's what this represents. All other things being equal. The stock price just going sideways. The volatility level staying the same the whole time. Is that likely to happen? I don't know. For 2 months or something, or whatever it is. You don't have to make it 2 months out. You can make it further or less. But I don't think it's necessarily an easy way to make money. I think there are easier ways to make money, especially considering that if the stock goes up a lot, you would expect calls to make money if the stock goes up a lot. But no, not in this case. Whereas if you had put on a vertical debit spread on Apple, and then immediately afterward Apple's stock price just shoots up, yeah, you'll probably make money. You'll probably do well. All right. Or if you sell a put or sell a put spread, or just buy the stock and then sell a covered call on your 100 shares of stock. All those strategies would probably make money if you put them on and then Apple stock just shoots up, or whatever it is, just goes up quickly. Whereas with this one, the calendar spread, if that stock goes up too soon, too quickly, you're probably going to lose money, right? If it goes down, you're probably going to lose money. You really need it to stay the same, and you need to be able to time that. Not easy to do. I don't want to dissuade you, because there are people who claim to make this work on a consistent basis. Cool. But there are other ways to make money if you have a directional assumption for the underlying stock. Or even if you think it's going to go sideways, there are ways to make money. Other ways, alternatives to this. But you might want to, let's say, virtual trade this, paper trade it, see if you like the calendar spread strategy. All right, so this was a basic introduction to calendar spreads. All right, and if you need more help with this, if you want some coaching, you can email me at davidmoadel@gmail.com. If you like this video, hey, please give it a thumbs up on YouTube and subscribe to my channel and hit that notification bell if you want to get notified whenever I put out more videos like this one. And if you want to leave a comment, that'd be great. Let me know. What do you think? What do you think of calendar spreads? Do they work for you? Do you like them? Do you not like them? Is there something better, a better alternative? Let me know. All right, I really appreciate it. Hope you learned something from this. And hey, more videos coming. All right, I'll talk to you again soon.